Hey everyone, welcome back to Corporate Decoder. It looks like EACO Corporation's quarterly report is here. And after looking at some of the numbers, maybe EACO's executives should try trading options on their own performance, because it kind of looks like they will be exercising some puts soon. But let's find out more. In this video, we're diving into EACO Corporation's latest quarterly report, also known as a 10Q. It's basically a financial checkup giving us insights into how the company performed over the last 3 months. This one ending in May of 2025. We'll cut through the technical jargon and see what's really going on with EACO's money. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. At first, keep in mind that EACO Corporation is a holding company, meaning its main asset is its ownership of other companies, mostly a company called Bisco Industries. Bisco is a distributor of electronic components and fasteners. You probably use them building PCs. They are used in everything from airplanes to computers. Most of EACO's report is Birstow's reporting company, meaning its main asset is its ownership of other companies. Mostly a company called Bisco Industries. Bisco is a distributor of electronic components and fasteners. You probably use them building PCs. They are used in everything from airplanes to computers. Let's look at how the company made money. This financial statement is called the Condensed Consolidated Statement of Income, but you can think of it as an income statement. For the 3 months, or Q3, ended May 31, 2025, EACO reported $1,812 only about $11,500 or $1,565 or $1,550 or 0.24 earnings per share on a basic dollar or $500 or $1,411,500 or 0.24 per fars earnings say $500 or 0.24 earnings per share. On a diluted basis, which represents all the complex financial trickery that might be converted to stock net income, was approximately 1,294,900% year on year. That's huge. Can they keep it up? CORP for the 9 months ended May 31, $2,000 out. The improved financial performance was due to the increase in sales, which we can find just a little further up. Net sales for the 3 months ended May 31 reached $141,000 versus about $961, $110, Pfizer 10, 151 sales. Totaled about $300 is approximately $260 million last year. So the company gained about $30 million in sales. What is interesting is that the gross margin, or the percentage of money made on sales, actually improved by nearly 1.5%. That means that the company isn't only selling more, but its operations are fundamentally more efficient, and the products themselves are bringing more income. That is also driven by how well the company buys products for resale, known as cost of sales, or the money the company ends up paying to get their hands on parts for you. However, expenses can often cripple a good company. Heb 2, the document states that the company has selling, general and administrative expenses, also called SG&A. They include the selling costs, staff pay and administrative overhead. All and those costs came at approximately Q3 2027 under during Q3 2024. Bas is nearly 260 is Aussies avel to the and ad an ik eder abad ad those worry $263,140. What is interesting is that if the company sold more, it was able to reduce costs associated to sales operations. This financial report mentions that selling, generals and administrative expenses were kept low due to one-time legal expense accrual and impairment loss in the past period. These are non-recurring and will not low expenses in the future. The income before income tax, also called pre-tax accounting income, increased to about $26,777 with an income tax provision of $316,200 versus only $360,200 in the prior year. The company increased by about $9 million in its income before tax. Okay, so that's how the company is doing on paper that the US government sees, but how is the business really doing too? Let's break down the Statement of Comprehensive Income, which tracks a broader range of financial changes. There was a gain for the company due to the foreign translation, which means that the money made abroad was more strongly converted in US dollars for the quarter. The company in total here has a grand total income of near $906,470 every 100 million, mainly due to a good change in currency exchange rate. Let's now switch gears and take a look at the balance sheet, which is mostly about what the company has for assets and liabilities at this particular time. Think of it like a financial snapshot for let's start with the assets. Cash and cash equivalents, also called short-term investments, and liquidities were quite positive. For the report period, the company has $72,700, up about $7 million from prior year. One thing to note is the restricted cash of $1,000 that has remained the same. I wonder what is it, but is not disclosed here. Probably a legal requirement or a deposit. The corporation also has trading securities for about $22 million. In total, the current assets, or the assets available to be used quickly, are about $173 million. That's quite a bit, meaning it can easily cover short-term wobbles or invest. Then the total assets are affected by operating leases and equipment. There are about $7 million in assets tied to long-term leases. Liabilities are what the company owes to external parties. Trade accounts payable or short-term invoices to pay total about $38 million to receive. There are also a number of accrued expenses. What you might notice is that as an asset, the company has borrowed approximately $4,921 in credit, meaning they don't plan to spend the money in the short term. If this credit was maxed out, I would give a strong negative rating, but a minor use is often a sign of confidence. Looking more into leasing, there are about $7 million in payments to be made on the company's operating leases. In total, there are roughly $72 million in liabilities, so about half the company's money is held there to about stockholders' equity. It includes common stock for just about $5,000. That means that the original money raised was from investors, including preferred stock, as well as earnings retained in the business over time. There are retained earnings of about $144 million, money that stays in the company after all operations. For a grand total of 146 million, Biscoe operates smartly and has good risk controls. There is also something interesting is the statement of shareholders' equity and how it changed. When the company earns less or has a loss abroad and needs to reconvert it to the domestic currency, it ends up losing money. For example, there was 131 in a foreign translation. This quarter there was income and foreign currency translation profits of around over 6 million. Finally, what about the statement of cash flows? This section will give more detail into changes such as losses from trading. It looks like there was near $200,000 in losses due to trading securities. Changes in account receivables or clients paying late and on credit also dragged down operations slightly, about 4.7 million. Operating lease right of use assets generated nearly $1 million in operations. Expenses being accrued also affected operations, the delay of cash movements. On a net cash basis, there was about 9.4 million in profit. Equipment also lost the company some profit to investing activities overall at $7 million, but that was offset by $4.5 million for the company's financing activities. There was about $4 million borrowed on the revolving credit, which is offset by about $100,000 on the long-term debts. The revolving credit might have been utilized considering how much the company has been investing. Overall, the company has a strong cash increase, so if that settlement actually bites hard, the company can make it through. Before we can judge any of this, let's talk about the risks in the financial notes. To keep in mind, these are stated by the company, so we need to consider everything else too. The company itself warns that a lot of these are just estimates. You can find the actual values in the future only. Internationally, the company does a lot of business in Asia and in Canada. So if their economies go down, so too goes the company's revenue. One factor that might drag on the future is lease commitments for all of Biscoe's locations, which amount to millions and millions of dollars per year. To do things like pay salaries and wages, the government will always get its piece. The company has a number of tax commitments which might affect performance. The company also has some litigation happening. There's a class action lawsuit that was settled for $75 million, and this settlement actually explains why a lot of expenses in the past year, such as from employee salaries and wages, were so suppressed because the company probably knew that they had to pay for something at the end. The company will take a hit, but they can manage. There wasn't anything that the company considered too important subsequent to the events. Acticay wrapping things up, EACO overall has had a great run this year. As we showed, the company's investments continue to look solid. There is a solid balance sheet and a good management team that is making wise choices. That is likely that it's luckier than smart, considering all tailwinds helping the company along. The company is extremely reliant on what happens on BISCO. While the lawsuit may be damaging, the company, however, has very strong and well-managed finances, so it's unlikely it will be damaged in the long end. Alright, that's our breakdown of EACO's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.